So good evening, everyone, and welcome to this evening's webinar. My name is Ellie Pressman of Barnet Wills, and I'm working alongside Chloe Rodway of Southgate Solicitors this evening. Before we actually make a start, if we can just do a little bit of housekeeping. Okay, some of you may be familiar with Zoom meetings. Zoom webinars is slightly different. You'll notice that your chat box actually is disabled, but if you have any questions, there is a box there marked Q&A for your questions. We will try to answer some of them as we go along. There will be some natural pauses where I will stop and try and answer the questions. But if we don't have time, then both Chloe and I will stick around at the end of the webinar and answer questions. And ultimately, if we completely run out of time, then any questions that go unanswered tonight, we will email you with a response. Okay, so just to reiterate what I said there. Okay, so this evening's agenda, right? So I'm going to cover wills and trusts. Wills, what they do, what they don't do, a little bit about trusts and how they can protect your beneficiaries. And then Chloe's going to be talking about family matters, pre and post nuptial agreements, cohabitation agreements, and so on. And then I'm going to be finishing off with lasting powers of attorney. And hopefully we should finish on time. We're still waiting for one or two stragglers, but I'm going to make a start shortly in any event. Okay, let's make a start, and if anyone joins in, they'll just have to catch up. Okay, so I'm going to start talking a little bit about wills, and let me just also apologise that I've got my virtual couple here, Bill and Vera, but obviously anything I talk about tonight will equally apply to people who are in civil marriages or civil partnerships or same-sex marriages and so on. And as my lot often is, I always assume that the man goes first. It's not always the case, but just for the purposes of these examples, that's just how I'm going to do it. So here in my example, we've got Bill and Vera, and they will invite a will writer to their home, or maybe they've downloaded a template off the internet, or maybe they've gone to see somebody who isn't necessarily a complete will specialist, and they will say, you know, we'd like to make a will, please. And what happens often is they're asked the question, no problem at all, what would you like to do? And sometimes I find that a little bit strange, because clients are not experts. They've come for advice, and they're not being given much advice. It's being thrown back to them as if they know what they should need or what they want. So invariably what Bill will say in that situation is that, look, if I die first, everything should go to my wife Vera, and when Vera dies, it should go equally to all the children, right? And obviously there's usually a mirror will, which is if Vera dies first, everything will go to Bill, and then when he dies again, equally to the children. And that is a standard will, and probably 95% of wills that I review are along those lines. Sometimes there are a little bit of slight differences. You know, maybe one wants cremation, the other wants burial. You know, mum sometimes wants to leave daughter some jewelry. Dad might want to leave his son his watch or something. But ostensibly, you know, they are mirror images of each other. So if that's what you have, what could possibly go wrong, right? Most people think, well, I've made a will, everything is okay now, I can sleep at night because all my wishes or what I want to happen is going to happen. So let's have a look at a case study. So this is a client called Arthur and Jenny. They've been married for nearly 40 odd years. They've got two grown-up sons, Mark and Andrew, and Andrew is married to a girl called Alison. Now, their estate combined is around about £750,000. So most of that is the family home, a little bit of savings and so on. Now, unfortunately, when Jenny was in her mid to late 40s, she was diagnosed with dementia. And unfortunately, by the time Jenny reached her sort of early to mid 50s, her dementia had gotten so bad that she had to be put into a care home. Oh, sorry, I should say that. Yeah, so she had to, sorry, her dementia got so bad that in fact, Arthur actually had to take early retirement so he could look after her full time. The problem was that about a year later, he actually died. So this left with the boys with the problem is that they couldn't give their dad the same care or attention that their dad had done. And so the boys actually decided that the best thing for mum would be for her to go into care. Now, under the terms of Arthur's will, everything actually at that point passed over to Jenny, and they were quite lucky because they did have powers of attorney in place. So the boys were able to look after the money. But Jenny then went into a care home. And this is really where the problem started. Because there wasn't a lot of cash in the estate, and most of the money was actually tied up in the family home, the local authority got involved and they actually forced the sale of the family home to cover the cost of Jenny's care fees. So this meant that when Jenny died, out of the 750, only £360,000 actually remained. So that was over half the money. So of course, under the term of Jenny's will, everything passed equally to Mark and Andrew. So they actually inherited £180,000 each. Within 7 months, Mark waved bye-bye to £90,000 because Alison divorced him and she took half of everything, including half of his inheritance. Andrew, on the other hand, he wasn't so fortunate. In fact, Andrew had a business that was in dire straits and he was in debt to the tune of nearly £250,000. So as soon as his creditors found out that he owed money, they were all over him. So in fact, he ended up with absolutely nothing because his creditors took everything that he inherited. So really what the story actually outlines, I'm just going to go back there. What that story actually outlines is 3 of the main threats to your money that your will won't protect you against or won't guard you against. Okay, obviously, care fees, divorcing or divorcing of your beneficiaries, and creditors and bankruptcy. Right, and despite having beautifully drafted, perfectly legal mirror wills, only 90,000 out of the 750,000 actually ended up where it's supposed to with one of the boys. That means that 660,000 was lost to the local authority, to an ex-daughter-in-law, and to creditors. That's 88% of the estate was lost to people that Arthur and Jenny didn't want, didn't plan, and certainly didn't anticipate. You know, and they're kind of probably rolling around in their graves, cursing the person that took their instructions, because not only did they lose £660,000 of their estate, but they weren't even made aware of the risk or the potential risk. Had they been made aware of these risks, they would have had a fighting chance. They could have put something in place to actually protect themselves and to protect their boys. But divorce and creditors and care fees are only 3 of the threats. There are some more. And although these are actually very, very common, there is actually one threat that's even more common. And it's not tax, before anybody types anything. Now, in the bottom middle there, you can see the chap sitting on Southend Beach. He's a client of mine. His name is Stuart Hurd. You may have been lucky enough to hear him on the news or read about him in the papers. Stuart was featured on the BBC. He was on Talk Radio, Mail Online. And this guy's really on a one-man mission to actually outlaw mirror wills, such as the depth of his feeling about them. Now, the story here really starts with Stuart's father, William, because when Stuart's mother died, his father, William, about a year or 2 years later, went on to find a new love, and ultimately he remarried a lady called Dorothy. And he then relocated to Wigan, which is where she came from. So, I mean, why he would want to actually leave Southend, I don't know, but there you go. Now, William and Dorothy popped along to quite a large firm of solicitors, and they said, well, we've just got married. We're aware that because we've got married, our old wills are automatically revoked. So we'd like to make new wills. And whoever saw them said, yes, no problem at all. You've come to the right place. What would you like to do? And so William said, well, if I die first, I want everything to go to Dorothy. And then when Dorothy dies, everything should be split equally between my son, Stuart, and her son, Michael. And if Dorothy dies first, then it should all come to me. And then when I die, again, it will be split equally between my son, Stuart, and Dorothy's son, Michael. And that's what the solicitors drafted up. And that's what they had, standard mirror wills, which I described earlier on. A few years later, Stuart's father dies, and under the terms of his will, everything passed to Dorothy. Dorothy then dies about 4 or 5 years after that, and Stuart discovers to his horror that, within days or weeks of his father dying, Dorothy had gone back to the solicitor and said, I want to change my will, and I now want to leave everything to my own son, Michael, and completely disinherit Stuart. There was never a bad word said between them. There was never, any sort of arguments, nothing like that. But with a, stroke of the pen, £300,000 of Stuart's inheritance was completely lost, and went to a stranger in Michael, who he'd only ever met twice in his life. Once at his father's funeral, and then the next time at Dorothy's funeral. And really, what really kind of makes his blood boil is that a lot of that money that he was due to inherit was actually money that had been passed to his parents from his grandparents. And so, generations of work and savings in that family were just lost to a stranger. And he'd also been forced to break a promise to his daughter, because he promised her that when he'd get this money, he would help her with a deposit to get on the property ladder. And of course, because the money never came through, he was actually forced to break that promise. So what I'm going to do now is just quickly recap the threats to your wealth that your standard will just not help you with. So on first death, so if you die and your surviving partner requires long-term care, the assets are at risk. If your surviving partner remarries and gets divorced, then half of your money could be lost in that divorce settlement, which Chloe will talk about later. And worse still, if your surviving partner actually dies before the new spouse, as in the case of William, the new spouse is in a position to disinherit your children. If your surviving partner has any financial difficulties, again, anything that you've left is at risk. And if there's any sort of means tested benefits, etc., again, they could be impacted. On second death, this is where the money passes to the children. There are still further risks. So if your children get divorced, that's half of your money potentially being lost to an ex-son-in-law or an ex-daughter-in-law. If your children go through creditors or bankruptcy, as in the case of Andrew, if the children themselves have care issues in the future, have any sort of means tested benefits, that could also be an issue. And then the last one is inheritance tax. Now, inheritance tax is a generational tax. And what I mean by that is that money that you leave your children adds to their estate. So it could be that when that same money is passed on to your grandchildren, they could pay tax on it again. And I had this happen to a client of mine quite recently. In December of last year, I had to see a client in North London Hospice, not far from me. He was 67 years old with terminal cancer, so it was very sad. And he literally was putting his affairs in order at the last minute. And sadly, he did pass away about 2 weeks or so after that. But 9 months before he died, his 93-year-old mother passed away, and she left an estate in round figures of £1 million. Now, she was divorced, so there was an inheritance tax bill on her estate of 200,000. So he stood to inherit 800,000 from his mum. But at the time he died, her estate hadn't finished going through probate, so money hadn't been paid out. So now that he's passed, that money will now go to his children, her grandchildren. But because it passes through his estate, it means that it picks up another £320,000 in inheritance tax. So the grandchildren, his children, will end up receiving 480,000 instead of the 800,000. And that's really the difference. Usually the time frame between your children and your grandchildren is going to be a lot longer than 7 or 8 months. But the result is always the same. The money, when it's passed from your children to your grandchildren, gets taxed again. So how can you protect yourself against any of this? Well, the solution is something called a trust. Okay. What is a trust? Some of you may have heard the term, may be familiar, some of you may not be familiar with trusts. A trust is nothing more than a legal obligation. It is a legal relationship between 3 parties, and I'll explain that those parties shortly. But all it is taking a little piece of law and using it to ring fence your money for the people that you specify. What can you put into a trust? Well, pretty much anything of value. You can put your house, you can put some cash, you can put your life insurance policies, stocks and shares, your business, your farm, pretty much anything of value. I've even got a client who's actually putting a racehorse into trust. Trusts are nothing new. They've been around, for hundreds or thousands of years. They really started when the knights would go off on their crusades. They would go off, before they would go off on the crusade, they would say to a trusted person, here are the keys to my castle and my lands. If I don't make it back from the wars, make sure my family looked after. And that's really how they were born. Now, trusts can be set up either while you're alive. So you can set up a trust tomorrow, put your family home into it, put some cash into it, maybe assign your life insurance to it. Or they could be set up when you're dead. So this is where the trust is actually drafted into your will, and therefore it's not live now. It doesn't actually come to life until after someone dies, until after the person who's made the will dies. And at that point, the trust comes to life. So we're going to have a look at some trust basics. So the person who creates the trust is referred to as the settlor. So if it's a live trust, if you create a trust tomorrow, then you are the settlor. Okay. If you're drafting the trust in the will, then you're the settlor also through your will. And then you've got the trust properties. Now, if you're setting up a live trust, it's a bit like opening a bank account. You have to have something to open it with. So we normally have a de minimis payment of £10. That creates the trust. And then you can add more cash or whatever as you go along, rather than in one go. Then you have the trustees. So these are the people who will actually manage and look after the trust for you and the trust assets, the money, the property, etc. And they can be beneficiaries. And then you've got the beneficiaries. These are the people that you intend to benefit from your trust. Okay. And as I said, the roles are interchangeable. So if you set up a trust while you're alive, you're the settlor, but you can also be a trustee. If you're a trustee of a trust, you can also be a beneficiary. And a settlor can also be a beneficiary of their trust. It's quite rare. Normally a trust would be for the benefit of somebody else. But there are circumstances in which we would create a trust where you would be a beneficiary of your own trust. And this is usually single or divorced people who want to protect their homes against the local authority or care fees by removing it from their estate. Now, the trust document, or the deed of trust, is nothing more than a document that formalizes the legal relationship between the settlor, the trustees, and the beneficiaries. So that's really all the trust is. It's a legal relationship between the settlor, their trustees, and their beneficiaries. And all the document does is formalize that relationship to say, this is the settlor, these are the trustees, these are the beneficiaries, these are the powers that settlors have in law, they have discretion, they can invest the money, they can, they can buy and sell properties, they can do whatever you like, but it's always for the benefit of the beneficiaries. It's for that's who they're doing it for. Now, how do the trustees know what it is that you wish them to do, or how you want your trust to be run after you're gone? Well, that's done through a document called the Memorandum of Wishes. It is your guidance to your trustees to basically say, this is how I want my trust to be run. Give them income but not capital. Don't let them have any money until they're 25. Whatever things you want to put in. It's not a legally binding document. It is just simply your instructions to your trustees. So let's actually have a look at a trust in action. So go back to Bill. Bill's passed away, and he had a trust in his will, and he's got £320,000 that's gone into his trust. Okay, the trust is for his wife Vera and her children, and their issue and remoter issue, which basically means the grandchildren and great grandchildren. So it's all the future generations can all potentially benefit from this trust. And he will have Vera as the surviving spouse as one of his trustees. We normally recommend, or we always recommend, that you have at least 2 trustees, because what happens if the trustee dies, or what happens if something happens to both Bill and Vera together? So the other trustee would normally be a family member or perhaps a professional trustee. And it could be 1, 2, 3, or all 4 of the children alongside Vera as trustees. So after Bill dies, Vera falls in love and gets remarried. I've put MAD there, that stands for marriage after death. This is Vera remarrying. It doesn't mean that she's mad to get remarried. It means that she's married after Bill's death. So now that she's remarried, how much of Bill's trust can the new husband have if either they get divorced or if he dies, or if Vera dies before him? Well, the answer there is nothing. He won't have a penny. John goes through a divorce, pretty much the same as Mark in the earlier example. How much of the trust fund that Bill's left is attackable in John's divorce? So how much can Bill's ex-daughter-in-law have of his trust? Nothing. So if Arthur and Jenny had trusts, when Mark got divorced, Alison wouldn't have been able to get any money that was left by Arthur or Jenny. Poor old Sharon, she goes into the office every single day, but when she gets there, she doesn't do any work, so she goes bankrupt. So how much of the trust fund is at risk from Sharon's creditors? Again, the answer is nothing. So if we go back to Arthur and Jenny, had they had trusts in their wills, not only would Mark have kept £180,000, well, actually, they would have kept more than that, because the local authority wouldn't have got any money either. So they would have had half the money each. Alex goes into care. So how much of the trust fund is means tested, or is it will impact Alex's care fees? Again, 0. So the local authority will not get any money from that. And then lastly, Kate dies. So how much of the trust that Bill's left is part of her estate for calculating her inheritance tax liability? Again, the answer there is 0. So that's really my little bit on wills and trusts. So before I hand over to Chloe, if you've got any questions, please just pop them into the Q&A there. I've got 1 or 2 in. Someone has put, will divorce revoke a will? Well, Chloe will touch on that, but a divorce does not actually revoke a will. So if you've made a will and you get divorced, it does not revoke your will. For the purposes of law, your ex-spouse is treated as having predeceased you. So if you say, I'll leave it all to my spouse and then to the children, then the children will inherit. Getting remarried does revoke a will, though. So the second you say, I do, any wills that you've made previously are automatically revoked. Do trusts have any annual fees or retainers? No, they don't. Remember, the trust itself is nothing more than a legal relationship, and the document just formalizes that relationship. So there's no annual fees or expenses for having a trust. If there are any sort of ongoing costs, they will still have to be paid in exactly the same way as if the trust wasn't there. So for example, if you inherit the family home from your parents and you decide to rent it out, somebody has to declare the rent to HMRC. If the trustees receive the rent, the trust will fill out the tax return and send it off to HMRC, and the trust will pay the tax. If the trustees give the rent directly to a beneficiary, then the beneficiaries will fill out the tax return, and it will go on their tax, on their tax. Can Sharon as trustee change the trust and add her new husband as trustee to gain the inheritance? If she was the only trustee, yes, she could, which is why we always have at least 2 trustees. So if that was the case, then John or Kate or somebody else would be able to say, no, we're not having that. That's not what mum and dad wanted. So trustees always have to agree. So normally the other trustees would actually veto that and not allow that to happen. What sometimes happens is that I've seen in the past is that you know, mum and dad leave a trust to their 4 children. Down the road, there might be 8 or 10 or 12 grandchildren. So the 4 children decide to have 4 trusts and go off their separate ways. And if Sharon at that point has her own trust on her own and decides to do that, she can do, but it will only be applicable to her share and it wouldn't affect her siblings. Can half siblings break a will if the couple leave their assets to their only child? The answer there is no. The trust is for the benefit of the beneficiaries specified in that trust document. So anyone outside of that can't break it and can't unravel it. Trustees will have discretion. So, you know, they normally have the guidance from the settlor as to what that settlor wanted to do. And so somebody who wants to challenge that is going to have a very hard time. The law or courts are very reluctant to break trusts unless, you know, there's really, really valid reasons. But if a challenge is made to a will, normally, and I think this probably might be one for Chloe to answer later on, but if there's a challenge to a will, the contentious practitioner usually has to have valid reasons, which are usually things like, you know, the person didn't have capacity to make that will. You know, there was something called coercement or fraudulent calumny, which is basically manipulating somebody. So that doesn't, you know, that if those circumstances are proved, then it's possible to invalidate the will. But generally speaking, if someone has capacity to make a will, the courts won't break a trust. How much does it cost to arrange a trust? Trusts typically are about £650 on average. Some trusts are a little bit less depending on the nature. If you have a will trust, it's around about £650. There are 1 or 2 other questions, but what I'm going to do is, can a hold a digital business? I don't know what you mean by a digital business, but if you own a business, then it's treated in the same as any other asset. You know, so whether it's sort of like royalties, that these are all assets that will pass through your will into the trust. So the trustees will own the rights, or they'll own the digital business, or they'll own the shares, or so on. So the answer to that is yes. Does putting up your property into trust avoid paying inheritance tax? No, it doesn't. Inheritance tax is a tax on the person's estate, and therefore it's usually paid before the grant of probate, so before the assets actually go into the trust. So, but it will avoid inheritance tax on the future generation. So the taxman will only get 1 bite at the cherry on mum and dad's death. Thereafter, once the assets or the property is in a trust, it will pass to all the future generations tax-free. Right. Okay. So I'm now going to be talking a little bit more about powers of attorney. Just to say that for those of you who are familiar with them, there are actually 2 different types of power of attorney. There's the health and welfare and the finance and property. Now, lasting powers of attorney have been around since 2007. They replaced the old enduring power of attorney. Although the Old Enduring is predominantly a financial document, the new ones cover both health and welfare and the property and financial. So let's have a look at them individually. I'm going to start with the health and welfare power of attorney first. Now, what a lot of people don't understand is that if you were to lose capacity and you ended up in hospital or being looked after in a care facility, all decisions are going to be made by the medical profession and the local authority. Okay, nobody has the legal right to make decisions for you. Not your spouse, not your next of kin. In fact, in this context, next of kin does actually not exist. So all the decisions regarding your care package are actually going to fall on the local authorities and the doctors. So without a health and welfare power of attorney, what decisions could be made? Well, a power of attorney will decide on your medical treatment, where you can and can't be treated, where you're cared for, your diet, your routine, right through to a life-sustaining treatment order. So this is where if you are, doctors can't do any more and someone tells you that, you want to turn the machine off. So the health and welfare power of attorney is very, very important. Now, with powers of attorney, the attorneys cannot compel a doctor to do something that he doesn't think is in his patient's benefit. Okay, so they can only withdraw treatment or tell someone that they don't want a particular type of treatment. So as an example, I had a case where my client had dementia, and he was also suffering from dementia as well. He also suffered, from cancer. He had prostate cancer. And as part of his treatment, he would have to go once a week for an injection. Now, because of his dementia, he didn't really understand what was happening. So after having the injection every week, he would be very agitated and distressed for several days. And so his daughter decided, you know what, enough's enough. She didn't want to see her dad suffering anymore. And so she said to doctors, look, I want you to withdraw the treatment because, I know that by not having the injections, we're shortening dad's life. He may not live as long, but at least have a better quality of life. At least he won't be sort of so distressed and agitated all the time. And the doctor said, no, this is not our job, is to keep him alive and to do whatever we can for him. But fortunately, his daughter did have the power of attorney, the health and welfare, and she said, look, as dad's attorney, I want you to withdraw the treatment or stop the treatment. And so they had to comply. But what she can't do is compel them to do some sort of treatment that they want to, that they don't want to give. So she can't make them, give some sort of experimental treatment, for example. So that's really the health and welfare. So it allows your attorneys to make decisions about your health and well-being, where you can be treated, what medical treatment you shouldn't have, your diet, your routine, and so on. The second power of attorney is the property and financial. Now, this is a separate document altogether, so you don't have to have both. You can have one or the other, or both. So the property and financial power of attorney allows your attorneys to run all your finances, pay your bills, collect money that you're owed, deal with insurance companies, buy and sell properties, all that sort of stuff, deal with insurance claims, claiming benefits, and so on. So again, I had a client who was called Mary. She had a stroke, and as a result of that stroke, she was in a coma for 4.5 months. Now, during that time, her family tried to cancel her mobile phone, and the phone company said no. They tried to cancel her redundant direct debits at the bank. I mean, she didn't need Netflix anymore. The bank said no. And in fact, Mary also had private health insurance. And so they tried to claim on that, but the insurance company wouldn't deal with them. Now, all these institutions, the insurance companies, the phone company, at the bank, they weren't doing anything wrong, either morally or contractually. And they all said quite rightly, look, if Mary had given us power of attorney, or had given you power of attorney, we could do this for you. But without properly documented permission, we cannot allow just, even family access to our customers' accounts. And when it comes to the banks, if you've got a joint bank account, the banks will freeze the account. This is the big British Bankers Association. It's their code of conduct, if you like. And 99 or 100% of the time, to cover their own backsides, if somebody loses capacity on a joint account, the banks will freeze that account until you either come forward either with a power of attorney or a court order. So if you've got a joint bank account and you haven't got a power of attorney, you could be in trouble. So what's the solution? Okay, the solution is to have a lasting power of attorney. This is a legal document where you choose exactly who you want to act on your behalf and to make decisions in the event that you're not able to make decisions for yourself. Okay, you can only do it whilst you have capacity. So it's a little bit like setting up an overdraft when you don't need it. If you've lost capacity, then it's too late. Okay, there are certain things that your attorneys cannot do, even with an LPA. So they can't make large gifts. They can't start gifting themselves money to, for themselves. They can't manage discretionary funds. Now that actually doesn't seem very important, but on that list, it's probably one of the most important things, because a lot of people don't realize this. But I had a case where my clients, who I did their wills and trusts for, had power of attorney for their dad, which I didn't do. They did it themselves, and dad had dementia. And so what they did was they decided that the best thing would be to sell his house and move him into the cottage next door to the daughter, so that she was around all the time and could look after him. And as attorneys, that's what they did. They sold his house, they moved him in next door. And as attorneys, they were doing everything absolutely by the book. There was no question. They were looking after dad with his own money. But it became apparent fairly quickly that physically dad was okay. And the problem was he was likely to outlive his money. And so what they wanted to do was they actually wanted to invest it or get a higher return. So they contacted their financial advisor who looked after the family for years, and they said, look, we want you to actually invest this money and make it last longer, because when it runs out, the financial burden falls on us, and it even split equally, it's going to be too much of a strain. But they found out that the power of attorney that did not allow them to do that. They were not allowed to manage discretionary funds or even delegate that authority to the financial advisor, unless there is specific wording added to an LPA, which I can do. So this is something a lot of people fall foul of. And if you have investments and pension funds and you've got people looking after money for you, a standard LPA won't cut it. Attorneys can also not pay themselves a fee. They can't purchase the donor's house at below market rate. The donor, by the way, is the person who actually makes the LPA. They can't do tax planning, and they can't use the LPA to benefit themselves. So these are sort of things that you can't do. So if you don't have an LPA, what are your options? If you lost capacity and you can't make a lasting power of attorney, then the only option is to go to the Court of Protection and apply for something called a deputyship order. So without that, the true cost of not having an LPA and having to go to court and to gain the legal right to do something through a court order is actually far more expensive. So if we look at the typical costs of not having an LPA, well, to bring an application before the Court of Protection to get a deputyship order is going to cost you around about £4,320 odd on average. And that doesn't include the solicitor's fees for preparing that application. So if you apply to a firm of solicitors, to actually bring that order, then you're probably looking at, maybe double that again with the legal costs. And then there are ongoing costs, supervision fees and bonds and so on. So without capacity, you're subject to deputy order by the courts, and it is quite onerous. As well as those fees, the courts are constantly looking over your shoulder. They may place limits on, the size of a check you can write. So, for example, if you've got a court order and they've said that you can't write more than £500 without permission, and you need to pay, I don't know, school fees or your car insurance or something, and you need to write a check for £1,000, you've got to go back to the court, get permission. They'll say, yes, no problem at all, write that check out for £1,000. And by the way, here's our bill for £250 for giving you permission. There's constant supervision, accounting. You've got to account for every penny that you spend. So a lot of people have said that the relief of getting the court protection off your back when someone who's finally passes away is just like a bereavement. It really is quite onerous, and it's quite difficult both financially and emotionally. Some of you may have seen this article in the paper. So Betty Figg appeared on the news a few years ago. She was an 83-year-old dementia patient being cared for by the local authority. And basically her daughter Rosalind was very unhappy with the treatment that Betty was getting. She would go and visit her in the care home. She'd be sitting there very withdrawn, very silent, not being very communicative at all. She would be holding a plastic cup of water and her hands would be shaking. And so what Rosalind, her daughter, decided to do would be to bring her home. So Rosalind sold her business. She adapted part of the downstairs of her house. She put in a new bedroom with an ensuite bathroom, garden rails, and security features. And she brought her mum home. And within an hour of mum being home, mum was starting to be chatty. She was drinking tea out of a china cup and saucer, a complete turnaround. 48 hours later, there's a knock at the door. Rosalind opens the door and she's greeted by 2 social workers with 6 big, beefy, burly police officers with a battering ram who were ready to smash her door down had she not answered. And they literally barged their way past her into the home and forcibly removed her mum back to the care home. Now, while all this commotion was going on, the neighbors heard the screaming and the shouting and so on. And so to try and hide it from the cameras, the social workers actually, put like a tea towel or a towel over Betty's head, so further adding to her indignity. And in fact, because of all the commotion, when they actually drove off in a rush, and they actually climbed a bollard as well. So imagine if that could have actually further endangered her life and actually caused quite a serious accident. Now eventually Rosalind went to court, and following a 7-month battle, the court sided with her and told the local authorities to release Betty back to Rosalind's care at home. But all of that aggravation, all that heartache, not to mention all the cost of going to court, take the local authority to court, could have been avoided if Betty had originally given her daughter's power of attorney. These are 2 other stories that were in the news in the last year or so, both similar circumstances. Both guys end up having brain damage as a result of an accident. The chap on the left was Paul Briggs. He had a motorbike accident. The chap on the right was Barry Vissler. He actually had an accident from a motorized skateboard or scooter of sorts. Paul was in a coma. The doctor said, there's nothing more we can do. And so Paul's wife and his mother, the family said, okay, fine, we understand, please turn them. In fact, the thing that was swaying them more was the daughter, who said, you know, didn't recognize her dad. She said, that's not my daddy. And so they asked the hospital to turn the machines off. And the hospital said no. And so Paul's wife had to go to court. And again, following a court battle, the courts sided with the family and compelled the hospital to turn the machines off. Barry Vissler, his wife, fortunately did have power of attorney, and she said, please stop the treatment. And so they had to comply. And I don't know whether you're looking on a phone or a tablet or a PC, but if you can read a little bit that's in red there, if you can't, the text is basically a comment from Bradley's wife, and she said that she genuinely thinks that if she didn't have that bit of paper, she wouldn't be able to get out of bed in the morning. That's how important that was. So it's very important to make an LPA, but if possible, don't wait until you've lost capacity, because deputyship then will be your only option. And it's going to be heartbreaking and frustrating for your families to be excluded from important decisions surrounding your health and your welfare. So the power of attorney itself, well, it's a 20-page document. Out says who you are as a donor, who your attorneys can be, replacement attorneys if your current attorneys can't act. So that could be that you might have your spouse as an attorney and your children as replacement attorneys, how they'll act, you know, guidance, restrictions, and so on. So it's 20 pages, has to be signed by everybody concerned. Court of protection, if you don't have an LPA, well, court of protection figures show that they're now taking up to a year to process an application. In fact, I've put there the power of attorney takes around 8 weeks. Actually, since COVID, it's gone up a little bit. They're actually taking around 14 to 16 weeks at the moment. But that's still a lot less than a year, and it's still a lot less expensive. You know, you're looking at only a few £100 to set up a power of attorney, over several thousands, maybe tens of thousands of pounds to get a deputyship order. And really, I liken lasting power of attorney to insurance policies. You know, I hope that my clients spend the money with me, but actually never have to use them. It's a bit like an insurance policy. We hope you waste your money and that you never need them. But if you do need them, or if you do lose capacity, then your powers of attorney are the most valuable tools that your loved ones have to make sure that you're looked after in the way that you would have wanted. So thank you very much. I will now take questions on powers of attorney. And I know that, Chloe, I jumped in and you had a few questions on your prenuptials and postnuptials, but I can see you've answered those. So, okay, so do we have any questions on the powers of attorney? Okay, so it says, who can be an attorney? Well, basically anyone over the age of 18 could be an attorney. You can have a professional attorney or usually a family member. So it's usually, in most cases I deal with, it's usually the partner or the children, but it can be family members. I did one today where it's actually a cousin. Someone is asking, do I need a business LPA? Or who can my attorneys be for a business? If you have a business, if you're happy for your spouse or partner to manage that business, then you don't need to have a separate business LPA. I have got clients who have business partners where they're in business with other people, and they will then have 2 LPAs. They will have a personal LPA where their spouse or their partner will manage all their personal affairs and their personal finances, and then they will have a business LPA where their co-directors or business partners could actually manage the company or the business assets. You'd only have 1 LPA for your health and welfare. Someone spotted, what is a certificate provider on the form? So a certificate provider is a person who has to sign your lasting power of attorney. And they are signing to say that they have known you for at least 2 years, and that in their opinion, you understand the consequences of what you're doing and that you're not being coerced or manipulated. So it's a bit of extra protection for you to make sure that somebody isn't actually, making you do it. But beyond signing to say that they've known you for 2 years and that you know what you're doing, they'll have no further involvement. It'll only be the attorneys after that. What happens if my attorney dies? Well, if you have more than one attorney, then obviously the other attorneys can act. If you only have one attorney, and that is your only attorney, and they die or lose capacity, you no longer have an LPA. And if you don't have capacity, you can't have a new one, and your family will have to go to court. So it's usually prudent or good advice to have at least 2 attorneys, and they can act either jointly, or you'd have another attorney to act as a reserve. So if your first attorney can't act, then your second attorney will actually take over. So I think we're going to end there. If there's no more questions, I think there's no more questions. So if you've got any questions, please pop them into the chat now. Otherwise, we can let you all go and have an early dinner.